Bismillahirrahmanirrahim. Alhamdulillah Rabbil Alamin. Wassalatu wassalamu ala Rasulillah wa ala alihi wa sahbihi ajma'in. I hope my voice is clear. First of all, I'm very sorry for. I'm traveling now, and there are some issues. So that's why I was thinking that whether to cancel or postpone it. But then, since the exam is coming up very soon, so I thought let's just proceed with it. And so, just to get the ball rolling, I will present on the new standard that is issued by AAOIFI on Murabaha. So I'll present on that. And as Brother Ihsan advised you, if you have any question, not only related to Murabaha, even if you have any question related to other standards, you can post your questions in the Q&A box, and so that later on we can answer these questions, inshallah. I'm not sure. I mean, can the participants unmute? Brother Hassan?
Raise hand. They can unmute. I will unmute them. They can ask questions.
Oh, okay, sure. Okay, fine. So let's proceed with Murabaha to start with. So next slide, please. Yeah. So Murabaha is one of the very earliest Sharia contract on which AAOIFI issued a Sharia standard as well as an accounting standard. As you can see, initially it was Sharia rules for investment and financing instrument Nong 1, Murabaha to purchase order. So as you can see by the numbers, it was the first one issued by AAOIFI from the Sharia rules perspective. Then they turned it into a Sharia standard number 8, and then later on they have issued another standard on tawarruk or monetization. But of course, our focus is financial accounting standard. So financial accounting standard number 2 was based on Murabaha and Murabaha to purchase order. Also they have issued another standard FAS 20, that is deferred payment sale. So later on in 2017, they have issued FAS 28, and FAS 28 basically supersedes the earlier issued FAS 2 and FAS 20. So in FAS 28, AAOIFI covers Murabaha and other deferred payment sale. So what is meant by other deferred payment sale? So a sale contract can be based on, for example, based on a musawama, a bargain sale. So where the seller is not required to disclose the selling price. So this standards number 28 covers Murabaha and other deferred payment sales. If we read the standard FAS 28, the accounting requirements are basically same, whether it is Murabaha or whether it is based on musawama. This standard FAS 28 excludes tawarruk. So tawarruk is not within the scope of FAS 28. The Ehsan, next. So major changes. FAS 28 brings major changes in the sense that it is more aligned with the generally accepted accounting principles. By that, basically, AAOIFI is referring to IFRS. So we'll see that previously in the Murabaha standard, Murabaha accounting standard, AAOIFI, for example, allowed a cash basis accounting. AAOIFI mentioned that profit can be allocated on a proportionate basis. But then what is meant by that proportional allocation basis? It was not clear in the earlier standard, earlier accounting standard on Murabaha. But new standard on Murabaha, it clarifies that effective profit rate method would be rather a more appropriate method in recognition of profit. So we'll see that shortly that AAOIFI recognized effective profit rate method in this standard. And also it has included financial accounting requirements for a purchaser. So when we talk about Murabaha, and if you remember the financial accounting standard, the previous financial accounting standard on Murabaha, it covered only the perspective of the seller. So like banks, when they apply Murabaha, banks are basically seller. Bank purchases based on any valid contract, and then they sell it based on Murabaha, and the bank is a seller in Murabaha. So in this standard number 28, interestingly, not only covered the seller's perspective, bank as a seller, it also covered the perspective of a buyer who purchases commodities based on Murabaha. So this 28 covers both seller's perspective and purchaser's perspective, but we understand that from a banking setup, bank is a seller. And also, this standard added a specific requirement to disclose sales and cost of sales in notes to financial statements. So previously, we had a discussion, like in the academic field, we are discussing that IFI requires recognition of sales revenue. IFI requires recognition of cost of sales. So are we supposed to report them on the face of the income statement or not? So we had such discussion based on the earlier standard. The earlier standard didn't really clarify that how we shall report this sale or cost of sales. But then it required a recognition of sales and cost of sales, but then it didn't really say how we are going to report it. But now this standard is very clear that sales and cost of sales will be disclosed in the notes. It does not require reporting of sales and cost of sales on the face of income statement. Like if you look at financial reporting of a manufacturing company or trading company, you'll see that they have revenue, they have cost of sales, they have gross profit on the face of their income statement. So banks, as a trader, in the case of Murabaha, bank will recognize sales, cost of sales, but then they will not report that on the face of income statement. They'll just disclose it in the notes. And previously, first two allow recognition of deferred profit on a recovery basis or cash basis. If you can recall, first 28 mentioned that if the Sharia board allows permits, then the bank may recognize profit on a cash basis. But this first 28 does not provide for this cash basis accounting. So this cash basis accounting is not there or is not present in the standard anymore. Okay, so these are the major changes. Next slide. Yeah. So let's look at the Sharia requirements. I believe everyone understands, but then this standard on Murabaha or accounting standard also covers the Sharia aspect of it. So what happens if you look at the flow of a Murabaha transaction? What happens basically? Bank purchases some commodities, and then bank pays to the vendor, and then bank adds a markup and then sell those commodities to the customer. So and the customer ideally pays back on a deferred basis, because deferred payment is not a condition of Murabaha, but in reality, banks apply Murabaha because bank is going to sell them on a deferred basis, and from there they make a profit. And in a Murabaha to purchase order, basically at the very beginning, customer will approach the bank, and the customer will express his interest that he wish to buy this and that, and then he will make a promise. And also at this point, bank may also ask the customer to deposit a security, a sum as security, like we call it hamish jiddiya. So in Murabaha to purchase order, customer will make a promise. Customer will order the bank to purchase customer, and then customer will also make a promise that if you buy these goods then I will buy them from you at that price. And also typically a customer also provides a security deposit, or we call it hamish jiddiya. Okay. So, and this standard also provides definition of Murabaha to purchase order. So the difference between Murabaha and Murabaha to purchase order would be that in Murabaha to purchase order, a customer makes it, customer orders and promises, and these are the basic difference between a general Murabaha and Murabaha to purchase order. Musawama also is a sale contract. So only difference is that in Musawama, bank is not required, or the seller is not required to disclose the price. But the seller is not required to disclose the profit. The seller is not required to disclose the profit in Musawama. Okay. Otherwise, the overall structure or flow is basically the same. Okay, next slide. Next. Now, I already have covered that. This standard includes Murabaha and other deferred payment sales, and it excludes Tawarruk, commodity Murabaha. I've yet to come up with an accounting standard on Tawarruk or commodity Murabaha. Okay. And for Sukuk also, there are specific standards, specific accounting standards, and I've also working on a new Sukuk standard as well. And recently, I've issued a exploratory draft on Sukuk Sharia standard. Okay, next. Okay. Now, this is, of course, in the exam, the questions will be in multiple choice format, but then I just put it for the sake of discussion, if you wish to discuss, according to AAOIFI, Conceptual Framework for Financial Reporting, paragraph 11C and the first 28 paragraph 4B, it says that An institution controls an asset or business when it has substantially all risk and rewards incidental to ownership of an asset or business duly meeting both of the following conditions. It is directly exposed to or has rights to variable returns from involvement with such assets or business, and it has the ability to effect those returns through its power over the assets or business. So basically, whenever we recognize an asset, we supposed to assess whether the entity has control over it or not. Now, what is meant by control? Control basically means you have control over something if the risk and reward associated to that belongs to you. So this definition of control is aligned with the definition of control provided in IFRS. But interestingly, as you can understand that if you are the owner, legal owner of the asset, only then you have this risk and reward. So somehow this legal ownership and control come together in our IFRS definition of control, whereas in IFRS we don't really see the requirement of having legal ownership. Basically, in IFRS-based reporting, without having legal ownership, an entity may also have control. Next slide. So just to give a brief answer. So if you look at resolution number 8, that says that the owner must bear the risk since the right of to profit is to the bearing risk. That's what basically is, I mean, in any case, Shoaib's argument that you have a right to make profit if you bear the risk. And if you look at first 28, paragraph 153 by 1, there it says the criteria for asset recognition and de-recognition shall be risk and rewards, or in accounting terms, the control. However, the control includes the rights to variable returns and the power to govern the asset. So ideally, purchase or having ownership over the asset gives the control over it. Yeah. Okay. Next slide. Okay. Next. So now we'll be discussing about accounting by the seller. So as I mentioned, the previous standard, previous accounting standard on Murabaha covered only the seller's perspective, and in banking Murabaha, bank basically is a seller. But this accounting standard on Murabaha covers both perspectives, seller's perspective and buyer's perspective as well. So a very big difference between IFRS-based reporting and IFRS reporting is that in Murabaha, in the accounting of Murabaha, IFRS requires recognition of inventories. So bank purchases inventories. So bank needs to, or bank purchases the commodities, and bank needs to recognize them in the book or in its book as inventories. And this is a very specific requirement, and it doesn't matter for how short the holding period is. So there is no mention of holding period in consideration of recognition of inventory. A very basic requirement is that bank must be the owner of the asset before it sells them to the customers. So since bank must be the owner of the asset, bank also must recognize the assets in its book after it purchases the assets. So how we are going to recognize inventories? Measurement at initial recognition will be inventory shall be initially recognized at cost. So what is the cost? Cost basically means cost of purchase plus other costs incurred in bringing the inventory to its present location and condition. So this point is very important. So cost is whatever bank has paid to the supplier. That's the cost. But then other elements will be added to it. So what are the other elements? Other cost incurred in bringing the inventory to its present location condition. So by that, it basically means bank purchases commodities from a supplier, and from there it will come to the warehouse of the bank. So whatever cost bank may incur to bring in the asset from the supplier to its warehouse, and that cost will be added to the cost of purchase or cost of inventory. So, and for example, all types of taxes other than those subsequently recovered, transportation and handling costs, costs incurred by customer in the capacity of agent, and all other costs directly attributable to bring the asset to its present location and condition, and minus trade discount, rebates, and similar items. So, if the supplier gives any trade discount, rebate, and such is that will be deducted from the cost of inventories. Okay. So next. Now, let's try. I mean, whether you have understood this concept or not. So let's recall the process flow of Murabaha. We have seen that in one of the earlier slides. So now, as you can see, step 1, step 2, step 3, step 4, 4 steps are there, and the measurement at initial recognition will include the cost incurred in step 1. So bank will recognize the cost incurred in step 1 only. Bank will recognize cost incurred in step 1 and 2 in recognition of inventories at initial recognition, or bank will recognize cost incurred at step 1 plus at step 3, or bank will recognize cost incurred at step 1, 2, 3, 4 at initial recognition of the inventories. What is the right answer? I think you can use chat box, I believe. Any response, anyone?
We shall continue.
I mean, participants may respond, or shall I give them 1 minute?
Definitely, if they want to respond, they can respond in chat for them as well.
Okay, because the answer is the next slide, so I don't want to do the next slide before they try. Anyone? You're sitting for the exam, I believe, and this is within this exam scope, right? So just try. Okay. Interesting. We haven't received any response. Why? Um,
I don't know. It's, I think it is. There is no. It's not okay. There is something in the chat.
okay.
Okay.
Someone's okay. 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 And let's go to next slide. The right answer is A, 1. 1. So yeah. So the right answer is 1. So basically, at initial recognition, the bank will recognize the cost incurred by it to purchase the asset, plus to bring the asset to its warehouse. Let's to make it simple, to its warehouse. So cost incurred at step 3 are to sell the asset. So selling cost is not part of cost of inventory. And the bank may also incur to make payment to the vendor. Let's say that the vendor is in a different country, or there can be some charges and etc. So that is also related to payment cost. That is not related to purchase. That is not related to the cost of purchase. And of course, step 4 is not relevant. Yeah, I think we understand that. Okay. Next slide. Listen. Okay, this one is a bit long. You want to try? An entity, let's say bank, has purchased some commodities to sell based on Murabaha. The expected sale price is 14,000, and the entity has incurred the following cost from purchasing to sell of those commodities. So what will be the initial measurement of the commodities in the book of the entity? So what will be debit inventories? Bank will debit inventories and credit, say, cash. So what will be the debit? Yeah. Let's try within 2 minutes. Because in exam you will have 3 hours, so basically 1.8 minute mark. less than 2 minutes.
Brother Misbah, I don't see there are two students of yours basically who are taking your course at the moment, been continuously in discussion with me for different things. They are not here, by the way.
Oh, okay.
Means two of them I know. I saw the list of the people. They are not here as well. So means I was expecting them to answer. So I checked the name of the list.
Okay.
Okay, I have an answer B.
Okay. Responded B. Okay, let's go to the next slide. Let's just save time. Answer is C. And the answer key is given 10,000 plus 50 plus 500 plus 300 plus 120 plus 20 equal to 10,990. Okay, so basically overheads will not be added, and tax that can be recovered will not be added. Other than that, other cost will be, and a commission to sales agent will not be added. Storage cost will not be added. Yeah. Okay. But if anyone have any confusion, I mean, you can of course ask the question using this Q&A box, and so that later on we can discuss. Okay, next one, Odessa. So you want to try this one? Okay. Okay, someone responded C. Okay, we have received two responses C. Odessa, next slide. C is the right answer. Okay, great. Next one. Now, so once we have recognized the inventories in our books, debit inventory and credit cash, and then what will happen to the inventories in the subsequent measurement? Subsequent measurement is relevant only if bank really holds the inventories. So it's very rare that a bank purchases inventories and then holds them and maintain the inventories at the end of the reporting date. It's very, very rare. But then just in case if it happens that the bank purchased inventories and there was no purchase order, bank didn't didn't manage to sell the inventories. So at the end of the period, bank is still holding the inventories. So what will happen, or how we are going to measure the inventories at the reporting date end? So at the reporting date end, inventories shall be measured at the lower of cost and net realizable value. So what is net realizable value? Estimated selling price in the ordinary course of business minus estimated cost of completion and the estimated cost necessary to make the sale. If you are from accounting background, probably you would know that IS2 provides the same definition of net realizable value. So at the year end or at the reporting period end, we will assess whether the net realizable value is lower than the cost, because inventories will be maintained in the book at cost anyway. So if the net realizable value is lower than the cost, then the bank will recognize a loss. A loss. So basically, credit will be inventory and debit will be loss in writing down of the inventories. So the recognition of this loss can be done in one of two ways. One is, as I mentioned, credit inventory and debit loss in writing down to net realizable value. Other thing is that we can create a provision. We can debit write down to net realizable value, and the credit will be a provision. So that is also another approach. So if it doesn't say anything about what shall be the ideal journal entry for that. So the entities have flexibility in determining their journal entries. But if you are attending the exam, so hopefully you understand that there are two possibilities in recognizing this write down. Okay, next one. Oh, another point. Sorry, previous one. Another point. This previous slide. If there is a purchase order, and in such a case, this assessment of writing down to net realizable value is not relevant. So if there is a purchase order and the purchase order also provided a binding promise, and the purchase order is a credit or the potential customer, ideally for a bank, all customers will be considered as credit or the potential customer, because otherwise the bank will not buy things for someone who is not credit or the. That's like a common sense. But in any case, the issue is that if there is a purchase orderer who provided a binding promise that he will purchase the inventories from the bank at a given price or at a predetermined price, and that purchase orderer is a credit or the potential customer. So in such a case, this assessment of writing down of inventories to net realizable value is not relevant. Yeah. Okay, next one. So this is about, again, if we had time, I mean, we could discuss in detail that the terms net realizable value, fair value, and etc. AAOIFI used these two terms, net realizable value and fair value. Is there any difference between the two? That is one question. That is a question one may ask. That are they same or there is a difference? Technically, there is a difference between net realizable value and fair value. But for someone who doesn't go into that much technical, then for him, net realizable value and fair value can be seen as the same. But technically, there is a difference. Net realizable value is, if you remember in the previous slide, we have seen that expected selling price minus cost to sell. That's how we determine net realizable value. But for fair value, it's based on three levels I mean, there are three levels of fair value determination. There can be market price and etc. Okay, next one. So for exam, probably the exam questions will not be that much technical. Based on our experience, the exam questions are not that much technical. But if anyone wishes to make things difficult, then of course these technical questions may appear. Okay, next one. So this is basically repeating previous scenario. Whenever the bank purchases inventories, it will recognize inventories. Debit will be inventories. You have already tried this question that debit inventories 10,990. It will be recorded as asset in the statement of financial position. And other expenses that are not eligible to be capitalized will be recognized as expense. So in their respective expense accounts, so they will be reported as expense in income statement. And if there is any tax recoverable amount, that will be part of asset. And if the bank pays in cash, credit will be cash. And if the bank has dues, then it will be recorded as a payable. Write down of inventories to net realizable value. There are two approaches. One approach is, as we can see in front of us, debit write down of inventories. So it will be as an expense in the statement of income or income statement, and credit will be provision for write down of inventories. So this provision is a contra asset. So basically 10,990, the asset carrying value, minus will be 8,040. Then we'll find the net inventory amount that will be reported on the balance sheet. But another approach is debit will be write down of inventories and credit will be inventories directly. So it depends on how an entity may design its accounting. But if it doesn't really dictate on whether we shall create a provision or we shall directly create inventories, it doesn't really say or go into that details. Next one. Sorry, something happened. Okay. Now this one, you can see a full purchase to sell cycle. So purchase and debit. This is another example. Purchase of commodities would be purchase inventory, credit, cash, or payable, as we have seen in the previous slide. And now, if the bank or when the bank will sell the inventories, how it will recognize that revenue and other things. So debit will be Murabaha receivable. As we understand that bank applies Murabaha as a technique to make a profit, and bank also sell this on a deferred payment basis. So in general, there will be always a receivable when the bank sells on a Murabaha basis. So debit Murabaha receivable 160,000. 160,000 is adding a markup of 10,000. Credit will be Murabaha revenue 160,000. So keep in mind that Murabaha receivable is a balance sheet item, and Murabaha revenue is an income statement item. But RFI does not require, or rather IFI requires recognition of Murabaha or presentation or disclosure, not presentation, rather disclosure of Murabaha revenue in the notes. IFI does not say that Murabaha revenue shall be on the face of income statement. No, IFI says that Murabaha revenue and cost of sales will be disclosed in the notes. So it is a very explicit requirement in the IFI standard. So credit Murabaha revenue 160,000. It will disclose in the notes, and then recognition of cost of sales and recognition of inventory will be debit cost of sales. So that will be also part of notes. And credit Murabaha inventory will be 150,000. So at the beginning we debited Murabaha inventory 150. Now we are crediting Murabaha inventory 150. So basically Murabaha inventory balance will become 0. And then recognition or recording of deferred profit. It will be debit Murabaha revenue 160. And the credit will be cost of sales 150. So balancing figure will be credit 10,000 as deferred Murabaha profit. And this 10,000 is a contra asset. The 10,000 is not a liability. This deferred Murabaha profit is not a liability. It will be treated as a contra asset. Okay, next one. So in subsequent measurement, receivables will be reported like this: gross amount of receivable 160,000. So this is basically cost of the bank plus markup 160,000 minus recoveries or other adjustment, including discount and rebates allowed. So just in case if the bank receives any discount, then also provides a discount to the customer, or a bank may also give a discount to the customer by itself. So that will be deducted. And then if there is any allowance for credit loss, that will be checked as well. And then net amount that carrying out of receivable will be 135,000. So we need to keep in mind that 135,000 is carrying amount of receivable, but that will not be the ultimate receivable amount that will be reported on the face of the balance sheet, because from this 135,000 we will also deduct deferred Murabaha profit, as we'll see in the next slide. Next slide. So at the initially at the time of sale, bank will recognize a deferred profit, and then how the bank will recognize profit over the financing period. So there are two approaches. And RFI said time proportionate basis. Previously also they said time proportionate basis, but I meant we, the readers, the practitioners, the academicians, we are confused. What was meant by IOFI when it said time proportionate basis? And many of us thought that IOFI meant straight line basis of profit recognition. That's how we interpreted. But then IOFI was not clear, and now it's very clear. So it says that profit will be recognized on a time proportionate basis, and if the financing is financing is for less than 12 months, then we will allocate the profit on a straight line basis. And if the financing is for more than 12 months, then we will apply an effective profit rate method. And this approach that if the financing is less than a year, we can recognize the profit on a straight line basis. If the financing is for more than 1 year, we'll apply effective profit rate method. This approach is aligned with IFRS. If you can recall, at the beginning of today's discussion, I have mentioned that, and of course, as IOFI mentioned, that this standard is more aligned with the generally accepted accounting principles, or i.e. IFRS. So basically, this requirement, as we are seeing in front of us, is very much similar to IFRS. So at the left side, we can see that bank applied effective profit rate method, and at the right side, we can see that bank applied a straight line bit. approach in recognition of profit. So if you have any question, I mean, please ask the question in the Q&A box, then later on we'll discuss, inshallah. Okay, next. From the perspective of journal entries is basically the same. Debit will be deferred Murabaha profit in both cases, only that the amount will be different. The amount will be different. As you can see at our left and also to our right, we can see debit deferred Murabaha profit, credit Murabaha profit. So debit Murabaha profit means that previously we credited deferred Murabaha profit. Now we're debiting it. So basically deferred Murabaha profit balance will decrease over the financing period. And we are crediting Murabaha profit that will be the income from Murabaha financing in the income statement. So in the income statement, we will see basically this Murabaha profit. Yeah. So on the income statement, I will not on the face of income statement, we will not see sales revenue, we will not see cost of sales. Rather, we will see Murabaha profit. Okay. And upon receipt of installment, they will debit cash and credit will be Murabaha receivable. And by Murabaha receivable, we meant the gross amount of Murabaha receivable. And except from of financial statement, as you can see in both sides, in the income statement or in the statement of income, we have Murabaha profit, and in the financial state, in the balance sheet or in the statement of financial position, we have Murabaha receivable. So Murabaha receivable basically the cost amount minus whatever the customer has paid, and minus will be deferred Murabaha profit. Deferred Murabaha profit will be gross amount minus whatever we have realized, and then as you can see at our left. 157,000 minus 9,600. So this gives us 147,000 reported as a Murabaha receivable. And on our right, we have 146,000 and minus 9,000, and that gives us 137,000. Okay, next one. Okay, so what is the right answer? As per past 28. Simple question. In exam, if those who speak for the exam, the difference between CSAA, for example, and this accounting firm module is that in the Sharia-based exam, the questions are very much simple in the sense that it's straightforward. But in here in AFA module, there are some questions involve calculations. So on an average, although we have only 1.8 minutes, but some questions may take more than 1.8 minutes. So that means that in some of the questions, we need to save time. Like this question. This question is a very straightforward question. We should be able to answer this within like 30 seconds so that we can use this time to answer calculation-based questions. And next, the answer, Reza. Next slide. 4. Okay, I believe most responded the right answer. Okay, next. Okay, so I think this is a very typical question that you may see in the exam.
Brother Misbah, there are question and Q&A. While they are answering this, you can read them.
Oh, okay, okay. Let me figure out how to read them. Hey, I don't see. Why I don't see Q&A?
You want me to read for you?
No, I mean I don't see the Q&A tab here. I think I need to be what, co-host or something.
No, there is Q&A tab open. That's why.
No, it's not visible at my end. Oh, there is. Sorry. Yeah. Yes, got it. Difference between implement loss and athlete loss.
Let me reveal the answer to this.
Yes, please. B. Okay. Anyone responded? Okay. I think it will take time. So B. Okay. Next one. I'll respond to the questions at the end, inshallah. Now, waivers, discounts, and write-offs. It is possible for a bank to allow waivers, discounts, are like we call it IBRA and IBRA, and then there can be also write-off. So, and the requirements provided by AAOIFI in this new standard is very good in the sense that it is a very systematic one. It was not present in the earlier one. It is a very systematic one. So you can see it provides 3 stages of recognition. The first is it is to be netted off against any available balance of deferred profit on such transaction, and secondly, any remaining balance is to be netted off against the profit recognized or deferred profit amortized during the current financial period, and thirdly, any remaining balance is to be recognized in the statement of income as an expense for the period. So an example is given, you can see here that I have added an example. So on 1 January 2003, an asset was sold based on Murabaha for 120,000. The cost was 100. So markup is 20, and my customer is paying in equal monthly installment. So that is 2,000 in 60 installments. So in 2005, the customer faced severe financial difficulty due to natural disaster and pleaded with the bank to waive part of the payment obligation. In response, on 31st December 2005, the bank granted a waiver of 9,000. So how the bank will recognize this 9,000 waiver? That is the question. So if we follow this approach, and the approach provided by AAOIFI, so basically we'll debit deferred Murabaha profit first, and then we'll debit Murabaha profit, that the profit recognized during the year, and then the remaining amount will be debited as expense. 1,371 will be an expense, and the credit will be Murabaha receivable 9,000. So this 9,000 will be written off, but then it will use 3 accounts when we'll be writing off this 9,000 receivable. So one portion will go to deferred Murabaha profit, and another portion will go to basically will be reversal of Murabaha profit we have recognized during the year, and the remaining portion will be an expense. In the income statement. Okay, next one for the lesson. Hamish and Arbon is one of the most very popular item. Hamish and Arbon in the Sharia standard, as well as in the accounting standard also. So basically, at the time of promise, bank will ask the customer to provide a Hamish or security deposit, and also you know that bank may also ask the customer to give an Arbon or earnest money. So anyway, debit will be a cash, or whatever the bank received, debit will be cash, credit will be Hamish and Arbon. The difference between Hamish and Arbon is that bank has a right over Arbon. Bank doesn't have right over Hamish in the sense that bank's right over Hamish is limited to any damage suffered by it if the customer breaches its promise. So if the bank concludes the Murabaha transaction, so Arbon will be netted off against receivable. But if it was given as a Hamish there are different approaches. One approach is that bank may return the money to customer, and customer will settle its obligations separately. That's one. Other is that bank and customer may come to an agreement that whatever is due by the customer will be netted off with this Hamish Jiddiya. So it depends on the arrangement for Hamish Jiddiya. For Arbon, it doesn't depend on the arrangement, because Arbon is simple in the sense that bank has a right over it, so it will be netted off against receivables. Okay, so you can see Arbon and Hamish Jiddiya set off against receivable. Debit will be Arbon or Hamish Jiddiya, and debit will be Murabaha receivable, and credit will be Murabaha revenue. Yeah. Okay, next one. Almost done. Concept checker. Anyone wish to try? The simple one, and the candidate must be able to answer this within like 15 seconds. Okay. Vanessa, shall we try the answer? Okay. It's treated as a liability by the seller. Okay. And okay, someone responded just to see. Yeah. Okay. Right answer. subsidy discount on inventory, and this is a very unlikely situation, but then we covered that in its Sharia standard, and also it covered the same in its accounting standard. But what may happen is that after the bank sold items to the customer, or even before that, the bank may receive some discount from the supplier. So how it will recognize that? In its books. So discount received on inventory subsequent to consummation of a sale, debit will be discount receivable, credit will be cost of sales, and and if the discount is passed on to the customer, then debit will be Murabaha revenue, credit will be Murabaha receivable. So you can see we will be debiting Murabaha revenue, so it will reduce the revenue amount, and we will credit Murabaha receivable, so it will reduce Murabaha receivable. And if the discount is not passed on to the customer, then it will be, if it's cash murabaha, again, in banking murabaha is rarely a cash murabaha. But in any case, debit will be cash or discount receivable, and credit will be discount income. And if it's deferred payment murabaha, which is the ideal or the real situation, debit will be cash or discount receivable, and credit will be murabaha, deferred murabaha profit. Yep. Next one. Other costs, there can be some transaction cost, as we have seen earlier. Whatever cost that we cannot capitalize, that will be recognized as cost in the income statement, following their respective heads. Like transportation cost will be under transportation cost, salary expenses will be under salary, and the rental will be under rental, and so on. Okay, and structuring other service fees. So bank may charge or impose certain fees to provide services to the customer. So what type of service fees the bank may impose on the customer, and it will depend on the Sharia. It will depend on the Sharia standards, on of course Sharia ruling. So assuming that bank is allowed to impose certain fees to provide certain services, like for example online banking services and etc. In such a case, that fee will be recognized as an income separately. Yeah. So this is not part of Murabaha. This is basically a separate income for the bank. Okay, next. Want to try? C. Okay, someone is putting C. Shall we try the answer? D. Okay, next one. Okay. But there's already have shown the answer. Okay, I mean, I think the slides will be shared. I'm not sure what is the plan. If it is shared, then of course we'll see. You can try them later. Next. Charity, yes. So AAOIFI does not allow imposition of a penalty over overdue amount. So if the customer does not pay his due on time, it is not allowed by AAOIFI to impose a penalty, because according to AAOIFI, it is imposing a penalty over the due or overdue amount is same as riba. But what AAOIFI allows is that AAOIFI allows um, um, for the parties to agree as such that if the customer delays in making payment, customer will pay a certain sum of money to the bank to distribute to the charitable purposes. So it will be based on an undertaking to charity clause. It will not be under a penalty clause. So although in terms of financial consequences, it's same for bank and customer, but from the Sharia perspective, the language is different. It is not under the penalty clause. It is under a undertaking to donate clause. So in any case, so whenever whenever the customer will delay in making payment, the bank will impose, or bank will ask the customer to pay this amount so that the bank can distribute to the charitable purposes. So when the bank will ask for the money, so debit will be charity fund receivable, credit charity fund is a liability account. And then once the bank will receive the amount from the customer, debit will be cash, credit will be charity fund receivable. So receivable balance will become zero. And then the bank will have the obligation to distribute this money to the charitable purposes. So debit will be charity fund once the bank will distribute, and credit will be cash. Okay, next. And these are the disclosure requirements, and it's very important to read them because there are sometimes questions appear from the disclosures as well. Okay, and goes on. Okay, next. And this is from the illustration. So yeah. So normally questions, I don't think questions appear from this, but just this is for better understanding. Okay, next. Again, this is just how it will be disclosed. Yeah. Next. So you can see in the disclosures, we have sales, we have cost of sales, and we have deferred profit, and we have opening deferred profit, less closing deferred profit, and then we'll have net profit for that period. So this is just an illustration of the disclosure. Next.
We've reached the end of the slides.
Oh, end slide. Okay.